The world investment markets were caught totally by surprise by the coronavirus. That's why the Dow Jones Industrials Average went from a high on February the 12th to a low on March the 23rd. That was a drop of over 38%. Now, if you've gotten your first quarter retirement account statements by now, you've probably noticed that you're down by about 1/3 in value. And I know that's a lot, and I know that it's scary, and I know that it's very, very disheartening. But I want to encourage you not to lose hope. I'm here today to help you and give you direction so that you can help your own retirement account. My name is Van Richards, and I'm a chartered financial consultant, and I design retirement plans that help people avoid running out of money during retirement. Now, I don't have a crystal ball and I can't see into the future, but I do have a considerable amount of background and experience in helping companies and individuals with their retirement accounts, and I'd like to share some of that experience with you today. First, it's essential to understand why we are where we are in the investment markets. When I say investment markets, I include stock markets, bond markets, and really any other type of publicly owned investments. All of these investment markets, in a way, have a mind of their own. That's when I say markets are going to react in anticipation of what that they think is going to happen. They kind of do have a mind of their own. Even though the world knew about the coronavirus back in December, the investment markets were caught by surprise. The markets did not anticipate that the effect the virus would have on the entire planet. When the disease was first in Asia, the markets thought China's got this under control. They're having a strong response. They controlled SARS and they controlled H1N1. But like Walter Mead wrote in his April the 13th Wall Street Journal article, China still misleads the world on the coronavirus. Once the real news came out about how bad this disease was in China, and then when the disease hit Europe, the markets were terrified. And when markets are terrified, what do? They fall. I want to talk for a moment about why this market correction is so different. Then in a moment, I want to talk about how the recession that I think we're going to be facing will be different too. Now, what makes this market correction similar to economic slowdowns in the past is the reduction in companies' productivity. What makes this market correction different is the personal safety issue, the fear that people have throughout the world about getting sick and dying. That difference will shape how the markets react going forward and how we come out of this. Now, you can look at all the graphs that you want to. You can try to draw all the similarities to all the bear markets of the past, but those comparisons are not going to be very helpful in this market correction because it is so different. Now, another key difference to this correction is that the economies of the world, especially in the United States, were so strong. That's going to be helpful going forward. We were overvalued by about 3% and suddenly are undervalued by about 20%. Now, some people think that because of that, the markets are going to bounce back like a rubber band to the pre-coronavirus days. I don't think that's going to happen. And really, I don't think it's ever going to go back to exactly the way that it was. Now, that does not mean that there will not be improvements. New sectors like technology, they're going to thrive. And then there's going to be other sectors like entertainment and food service and personal health and travel. Those are going to have to make some serious changes or else they're going to disappear like telephone operators of the past. So if some people think we're going to bounce back and it's going to be like a V, like a rubber band, I don't agree with that. Now, those who are drawing comparisons to previous bear markets with charts, etc., they think that we're going to see a U. It's going to be a slow recovery. I don't agree with that either because of the big differences. What I think is going to happen is we're going to see a market recovery that's going to look like a W over the next 12 to 18 months. We're going to see some declines, we're going to see some advances, but I feel that it's going to become less and less dramatic over time. So that brings me to my 3 forecast for the future going forward. One, I've talked about. The market's going to have an unsteady recovery, I believe, over the next 12 to 18 months, kind of like a W. I believe sincerely that we are going to be in a recession. That means we're going to have at least 2 economic quarters of negative GDP. Now, this is going to be a different recession than what we have experienced in the past. It's not going to happen because the economy grew too fast like it did in 2001 that caused the dot-com crash. This recession is also not going to occur because of the federal government's intervention. Like back in 1981, when the markets fell, the government changed interest rates. The Federal Reserve raised interest rates to combat inflation, and it triggered a recession. The bull market ended in February because of government policy decisions to keep people home and to help them to prevent the spread of the coronavirus and to keep them safe. Now governments throughout the world, they're really functioning as a buffer to bridge their economies. They are keeping people safe, and they are partially keeping the economy open. That leads me to my third point. The markets are really not going to be as surprised as they were. It's kind of like they're in a valley and they can see the other side of what's coming. They can anticipate better because they see what's happening. The future does not seem as unpredictable, and certainly not as much as a surprise as it was in February. The reason I expect the market to recover more like a W is because we are going to experience some setbacks. So be prepared for some volatility as we go forward in these markets. Now, if you're retiring or you are in retirement and you have the ability to have cash, prepare a buffer that could last 2 to 3 years. Now, you might be saying, I don't have 2 to 3 years of cash. Do what you can. Prepare for the volatility. If you're thinking of retirement, you might think of putting that off. If you have a long time to go before retirement and you can tolerate the investment volatility, consider staying in the investment market. However, you may need to take some steps to look at your investments because there may need to be some changes because of industries that are affected, may be affected for a very long time. You may need to adjust your strategy accordingly. Now, let's also not forget about income taxes. The market decline may be an excellent time to take advantage of tax losses. Look at a Roth IRA perhaps, or taking some taxable income when rates are lower. Congress is spending money at an unprecedented rate. With all of the public assistance programs that Congress is instituting, they're going to have to find a way to pay that, and it's probably going to be with higher income taxes. So you would be wise to anticipate higher tax rates in the future. Thank you for taking a few moments to listen to my opinions today, and I'd like to remind you that they are just opinions. The past performance of investments are not a guarantee of future results. You need to read your investment documentation and your prospectus very carefully to understand the risk of the investments and the fees that might be involved. My name is Van Richards, and I design financial plans for people that help them avoid running out of money during retirement. If you would like to talk to me about your retirement, visit my website at richardsfinancialplanning.com to arrange a time to talk. Have a great day.